All right, welcome to week 12. So we only have 2 weeks left. My agenda for this week and next week is to finish up options for today, for sure. And then if we have time to cover cryptocurrency, specifically Bitcoin, I'll do that today. And then whatever spillover, I'll finish up next week. So next week, I will talk about the final exam logistics. And before we meet, I will also hand out most likely some practice problems, which I'll go over in class. So from now until next week, please come with questions. So if there's concepts that you would like, for example, more practice questions, I'm happy to kind of go over some sample questions next week. So next week is specifically for you to, clarify concepts that's still foreign to you, and hopefully that's enough. We can do that in class together. Okay, so last week we stopped at hedging using options. So just to summarize where we started from. So we started with very simple concepts of hedging using futures and forward contracts. So again, the difference between futures and forward is futures are standardized contracts, forward contracts are bilateral and very specialized. So finding the right counterparty is very important, and it's very hard to unwind if you have forward contracts. Futures, again, standard contract, very liquid. If you work with futures, it's very easy to unwind and so forth. The difference between futures and options is options is not an obligation. So you don't have to exercise the contract by the time of maturity. Okay, so take, for example, a long forward position versus a call option, right? So long forward means that you're going to buy the underlying asset sometime in the future. You have to, that's the agreement. Whereas the call option, there is a contingent condition in which you would exercise and purchase the asset at some pre-designated price called the strike price, right? So again, the difference, the subtle difference is the option is a contingent claim in which you have the right but not the obligation, or forward contracts is an obligation. Okay, and because it's a contingent claim, the way it's designed, call options and put options and so forth have value at the time of issuance. Okay, and valuation of these contracts are very difficult if you don't understand the new math. Okay, so hopefully by the end of today you have a very conceptual understanding why option price are priced the way they are, and how pricing options is fundamentally different than pricing stocks, bonds, and forward contracts. Okay, so that's hopefully what I can convey to you by the end of today. So before we get to pricing, however, I want to go over how to use options to hedge against specific risk given your current position. So just like forward contract, we talked about the case in which we had a long position and short position, and how we can hedge those positions using short forward or long forward contracts, right? Same thing for here, but it's a little bit subtle here for options. We have some degree of flexibility in deciding how much we want to hedge, as you will see soon. Okay, so that's what I'm going to do right now. I'm going to go over different types of positions that you may have exposure. So for example, you may have asset positions or liability positions. Again, asset position means that you bought an asset and you're fundamentally betting that the asset will increase in value, and that's how you make money. But perhaps over time, you realize that that bet may not be such a good idea because you have new information, and you want to kind of hedge against, move away from your original bet, right? That the underlying asset will increase in value. And depending on how your information change, you may want to protect yourself against large drops or small drops in value. And so this is where call options come in handy. You have this flexibility to design your hedging, whether it's very large or very small drops in value. Whereas in forward contracts, it has to be blunt, right? You have to give up everything, right, in order to hedge against, your original bet. Okay, so that's right. Same thing for assets, same thing for liabilities. Again, liability just means that you sold something today, you need to buy it back sometime in the future, right? You need to buy, so-called buy to cover your position. And you want to buy as cheaply as possible. So in other words, you're betting that the asset that you sold today will decrease in value over time, right? And so depending on how your beliefs change about whether or not the underlying asset decreases in value, you may want to hedge large increases or small increases in the underlying value, right? Again, if your liability position, that means that you're betting the asset decreases in value, but if it suddenly increases, then you want to find ways to prevent losses, right? And so this is what options affords you, okay? So let's go ahead and let's go over how we can hedge against large drops in value. So this is a long position. So we initially have a long position. Is our original position. And then we're going to short a call. Okay, so that's what we're going to do using a payoff table, number one. And then we're going to draw the figures for each position and then add it all up and then figure out what our ultimate payoff looks like after we combine our long position and the underlying asset plus the option, and to give us a sense of what we are hedging against, right? And so our final payoff, and there you can characterize it. Okay. All right, so let's go ahead and do the payoff table. So just like last week, we're going to look at payoff at time at payoff now, and then t, or just sorry, payoff at time at t, at time t. Okay, I think that's the notation I used last week. ET is less than K. So E capital T is less than K. So again, K is the strike price for options contracts, and K is less than ET. Yes. So if the underlying asset sometime in the future at maturity exceeds the strike price, then something is triggered. All right, so let's draw the table. Draw some lines. Separated. And let's go ahead and analyze scenario. All right, so if you're a long position, that means specifically you bought something today and you're betting that this asset, or this, in our case, currencies, will appreciate in value over time. So if we bought a currency today at time t, so that'd be a minus t, right? ET, meaning we bought it today. And we're hoping that the underlying asset will increase in value in our domestic currency. So E capital T is going to be our realization, regardless of whether or not it's below or above the K, right? It doesn't matter if ET is above or below, our original position will always give us E capital T. And we're going to, that's what our plan is. We're planning to sell what we bought at time little t, right? And if we want to hedge, we're going to short a call. So when we short something, we're going to sell something. Or in other words, we're issuing a call option, in other words, right? So that's going to be a sale of a call option. So C is the price of the call option. And the call option will only be exercised by our counterparty if the underlying asset exceeds the strike price value. So if E underscore T is lower than K, that's going to be a 0 because our counterparty is not going to exercise, right? It's out of the money. But once ET is greater than K, it's going to be in the money, and our counterparty is going to exercise it, if assuming they're rational, and our final payout is going to be E underscore T minus K. Again, it's the difference because our counterparty is exercising, right? And that can be also rewritten as K minus ET, right? All right, so our final payoff will look like the following. Oops, look like the following. Here. C minus E underscore small t is our initial payoff at time t. At in a scenario in which the underlying asset is lower than K, it's going to be just ET. And our in this scenario in which ET is greater than K, our payoff is just the sum, and which is just K, right? Because ET cancels out with minus ET, and all we're left is K, so that's our payoff K. So I have a question for you. So based on this table, should this payoff in the beginning for ourselves be positive or negative? If we believe the no arbitrage condition is true. So if you have the answer, just say it. So the hint is this is positive for sure, right? An asset must have positive price, so it's positive. K strike price is going to be positive for sure. So is this going to be positive or negative if no arbitrage holds? Should be negative, right? If it's all positive, then I get something for nothing, right? I get positive payoff no matter what. I get positive output payoff now, and I get positive payoff in the future. So I get basically infinite money if I do this, right? Free money. It cannot be true. So if no arbitrage is true, then this must be negative, right? You have to pay something for a chance to win something. If you win no matter what, then you have an idiot counterparty, or something's wrong with the markets, or it's priced incorrectly. Okay. All right, so let's visualize this using graphs. All right, so it should be quite clear what's going on. So for our unhedged position, right, we start with the unhedged position. So I'm going to write unhedged here. I'm not going to label so much stuff, but so unhedged just means that without engaging in call or put options, I'm just holding the underlying asset, either short or long, in this case, long. Our payoff should be just linear, right? Should just look like this. Where the origin should be E underscore T, right? And the labeling for the x-axis should be E capital T, right? The realization of E capital T. If E capital T exceeds E little t, then our payoff is positive, right? That's represented by this upward sloping curve above the origin. On the other hand, if E underscore T is lower than E little t, then we're going to get a negative payoff, right? Because we've determined at time zero that we must sell what we bought today sometime in the future. So that's our payoff. Okay. We want to hedge. Let's say, suppose we want to hedge against the possibility that we don't want so much exposure here. We want to perhaps make an exchange between getting a lower future payoff and not having such a steep decrease in our payoff in the scenario in which E underscore T falls below ET. So we want to kind of limit its losses. How do we do that? So as I said earlier, right, we're going to short call. What does a short call look like? You can go ahead and draw that. So a call option looks like this. So short is just the mirror image on the x-axis. Of course, we can obviously look at this row just to get an idea of what's going on. So that means that if E capital T falls below the strike price, so the origin is the strike price, K equals ET, then our payoff is going to be zero, right? As we saw here, right? Zero. So we just have a flat line. We have limit. This is our limit, right? Loss limitation of our losses. If E capital T exceeds K, then we have to pay out, right? Then we have some losses going on here. So it's going to be downward sloping, right? Right. This means the intersection at K and then downward sloping curve, right? You just look at this graph. So hopefully you remember your algebra, right? The constant term is the intercept point on the y-axis, and the negative one is the downward, means the downward sloping curve on the x variable, right? So in this case is ET, and so it's going to be a 45-degree line like this, right? So adding these two lines together, you can kind of already see what happens. This upward sloping curve is going to cancel this upward sloping curve, so you're just going to get a flat line on the right side. But the left side is going to be just still downward sloping, right? Because not 0 plus some negative number is still a negative number. So our final payoff structure should look like this. Let's see. Should look like that and like that. And then let me label some stuff here. This should be K equals ET. And if we were to factor in this initial cost, it should be. Sorry, let me draw it higher. So I think it should look like this initially, and then it should go down to C here. So this point is C, and this point is K equals ET. Yeah. Okay. So the second line is factoring in the initial cost. That's why it's going downwards. Okay. Oh, sorry. I just realized I'm doing the wrong graph. Sorry. Let's see. Okay, so rather than reorganize our labels, sorry, I'm going to start over. So I apologize. So sorry, I gotta clear this. Sorry. So maybe I will, so everything else, okay, so I apologize. This is for something else. I did the same thing before, so I apologize. And this is bad. I know it's bad. All right, I'm just gonna clear it. Sorry. I'm gonna do this fast because I'm sorry. Okay. So this should be asset position plus long put. Sorry. So I wrote short call, that was wrong. I was looking at the wrong slide. I'm gonna do this fast because I realize I'm gonna otherwise be redundant. Okay. So everything's the same. The only difference is that we're not doing short call, we're doing long put. So let's go ahead and do that. So this is all the same. Okay, this is all the same. And we're gonna long put. So long put just means rather than buy a call, you're buying, sorry, shorting a put, you're buying a call. Long means to buy. So we have to pay for the put, so it's a minus P. Okay. All right, so maybe I'll go slow now. So asset position, it's clear, right? You have to buy it today and then sell it sometime in the future. And so you're betting that the asset value appreciates over time. To hedge against large drops in value, you have to do something on the right side of the graph, right? And so a long put will be able to cap the left-hand side of the graph, right? Because the long put's going to look like this, right? And that tail is going to go the opposite direction as the other tail, right? And so you're going to get a hedge. right? At a fixed value. So you'll see it soon. So if you have a put option, you're betting that the underlying asset will fall below the strike price, and you would only exercise if K is less than ET, in which this is a positive value, and you exercise. Conversely, this is the opposite of a call option, right? If you have a put and the underlying asset exceeds the strike price, you're out of the money. Exercising means you get negative payoffs, so you would never exercise. So 0. So our final payoff looks like the following: minus P minus ET for today. That's the price of buying the asset and also paying for the hedge, which is minus P. You would receive a value of K in which the underlying asset falls below the strike price K. So you see that, right? Because ET cancels out with ET here. So all you're left with is K. And at the end, your payoff in the case in which the underlying asset exceeds the strike price, it's still ET. So just like the other example, right, we know that the strike price is a positive value. We know the underlying price is a positive value. So if positive sometime in the future, there's a gamble, of course. And that gamble you shouldn't be paid to take on this gamble. It should cost you some money. So this value should be negative, right? Because otherwise, obviously arbitrage. It's a free lottery otherwise. Okay, so let's go through the hedging again. Sorry. So this part should be clear, so I won't spend too much talking about it. Unhedged payoff. This is E underscore T. X-axis, the realization of future. E, the payoff is going to be 45-degree line. And you can hopefully see that because it's a line that cuts through the origin because it has a 0 intercept term, right, from your algebra. And it has a slope of 1, so it's a 45-degree line. All right, so let's add that with our hedge, which is a long put. A long put is a bet that the underlying asset falls below the cutoff, right? So we can see what that looks like, in which K is equal to E square T. That's the at the money, right? When K equals E underscore T, that's at the money. That means if you choose to exercise, it's gonna give you a 0 payoff. But if E underscore capital T exceeds the strike price, you should get a positive payoff, right? If it falls below, okay, all right. And you can see what happens. This positive payoff is going to cancel out this negative payoff. So that's where the hedging comes from, right? And when you have a positive and negative sloping thing add together, you're gonna get like a solid horizontal line, right? This upward sloping and this 0 line is still going to give you a upward sloping line. So that's exactly what we see over here. So you should get something that looks like this. If we ignore the initial payment, you should get this line should be K equals E underscore T. And if we factor in the initial cost, that's a downward shift of the curve to this point here. And this point here, this intercept should be negative P. All right, so hopefully you see what's going on. You don't give up the upside, and you can see that, right? Because your final portfolio payoff, you still get this upward sloping line. Of course, it has to exceed the initial cost of the put option first, right? That's why it's still negative here. So it's possible that if the underlying asset doesn't appreciate enough, you still get a negative payoff. So you need to overcome a larger threshold to get a positive payoff. But there is a benefit. The benefit to this is that your ultimate downside risk is completely removed, right? It's a flat line, right? You're the most you can lose is P, right? That's the most you can lose. I mean, the losses, your losses is capped at minus P. So this is, so let me do some labeling. This is long put, and this is the hedged payoff. So to summarize, this is a hedge against large drop in value, and this is assuming you have an asset position. Asset positions suggest that you bought something today and you're going to sell it sometime in the future. So you're hoping the underlying asset appreciates in value. To protect yourself from huge losses, in this case, you should probably engage in a long put. Long put is a hedge against the scenario in which the asset falls below the strike price K, right? And when you combine both of these positions, you can see that the entire downside risk is neutralized, right? You get a limited cap of your total losses, and but you have to pay for insurance, right? That's why this minus P still exists and shifts the entire payoff curve downward. But you still retain the upside in a scenario in which E underscore capital T becomes very, very large. So you still have unbounded payoff, right? Because ET could be very large, in which case you could make a lot of money. Okay. The point is here, the point is that you have to pay for insurance, and that's represented by this triangle here. All right, so that's the big picture analysis of what's going on. Okay, so hedging against large increase in value. So this is the same idea, but now rather than a asset position, we have a short position. That means we sold something today and we need to buy it back sometime in the future at a cheaper price, hopefully, to cover our initial sale. So let me summarize what we're going to analyze. We're going to analyze a liability plus, in this case, long call. And let's go ahead and analyze this in two ways. One in using tables, the other using graphs. Payoff at time lowercase t, E underscore capital T less than K, and K is less than E underscore T. All right, so I forgot to make an assumption here. So for simplicity, I assume that K equals E underscore T, right? To make the graphs look better. Okay. So I'll write that here too. Assume that K equals E underscore T for graphs. Okay. All right. So again, liability position. We sold something today, so we received E underscore small t, and we are hoping that when we buy back the asset, it only cost us E underscore capital T, and hopefully it's very low, right? So our payoff, regardless of the state of the world, when I say state of the world, it means realization of the asset in the future. Two scenarios, right? Below and above K. It doesn't matter. I will still have to buy it back at E underscore capital T. So note the minus sign, right? I have to buy it back. If I want to hedge against the possibility that I'm wrong, that E underscore capital T actually increases as opposed to fall, I can engage in a call option. So I will buy a call option. A call option is a bet that the underlying asset exceeds the threshold, K. So if E underscore T falls below K, I won't exercise it. Therefore, my payoff is 0. But if E capital T exceeds K, my payoff is E underscore T minus K. And so my final payoff today would be E underscore lowercase t minus C minus ET in the case in which ET falls below K, and the case in which ET exceeds K, it's going to be minus K. And all we're doing is summing the columns. So I hope that's clear. We're just summing the columns. So here the E's cancel out, and all we're left is with K. So we draw the lines, separate our calculations. Okay, so let's see what our payoff structure looks like. So I think the unhedged position is trivial, right? It's just a downward sloping instead of upward sloping. And I'll label everything. So this is E underscore lowercase t. And this is E underscore capital T. And we're going to add it to our hedge position. I mean, our hedge, which is a call option. We know what a call option looks like. It's a upward sloping curve and then a flat curve here, right? This is K equals E underscore T. Again, this assumption, I'm assuming that that's that, so that the graph looks good. And this is E underscore capital T. So we can already visualize what's going to happen when we combine the two positions. We have downward sloping with 0. That still gives us a downward sloping curve, but our upward sloping with downward sloping is going to give us a flat line. So what we're going to get, as I said, a downward sloping curve, and it's going to be this down here actually. Okay, and then if we consider this, we should get something that looks like this. Oops, sorry, the curve should be the same slope. Okay. All right. This is minus K, and this point here should be minus C. And of course, the x-axis is ET. For ET. So just based on this payoff, this is negative, right? This is negative. This shouldn't be negative, right? This should be positive. Otherwise, you would never, ever do this, right? You would never, ever do this. Everything gives you negative payoff, and then you're paying again today. It doesn't make any sense. So you're hoping that you retain some value of this today, right? And so it's positive. And that's why it's an upward shift in the curve. All right, so summary, what's going on? You have a liability position, meaning that you're hoping the underlying asset decreases in value so that you buy back cheaper. So as you can see, if it's to the left of the unhedged position, you get positive returns. If it's to the right, you get negative returns. We want to mitigate this downside risk. We can engage in a call option. You can see why it's mitigated, because a call option is essentially a long position in the underlying asset above the strike price K. And so combining this negative slope with this positive slope should give you just a 0 slope line, right? Which is here. And then this hedged position plus this downward sloping curve should still give you a downward sloping curve. factoring in this cost should shift the curve upward. And you see that your downside risk is mitigated to the right of the graph here, right? It's mitigated here, right? It's flat, it's completely limited, and you still retain some upside, but you have to overcome this insurance triangle, right? This little edge here. So that's the price of the insurance. So you have to exceed some higher threshold level in order to get a positive return. Hopefully that's reinforces the intuition. Okay, so that's the scenarios in which you're trying to do a big hedge against large losses, in which case you want to eliminate like the entire downside risk scenario. If you want to not have to, if you know that there won't be major losses, you don't have to go this route. You can actually go a little bit more subtler. So this is scenarios in which you want to hedge against small drops or small increases in value. And while we give up some upside, we trade that additional upside for some guarantee. Okay, so you get the scenario in which you have more of a scenario in which you get a positive payoff than before. Okay, in other words. So let me summarize what we're going to do here. So this is asset position plus, now in this case, a long put. Payoff at t, e underscore t, k, and k less than e. All right. Long position, obvious, right? Trivial. We buy it today, we sell it tomorrow. So plus et and plus et. And since we're longing a put, we have to pay for the put, so it's a minus p. And the put would only be executed, right, if it falls below the cutoffs. So k minus e capital T. Otherwise, you would not exercise the put if it exceeds the strike price, in which case our payoff for this contract alone is 0. And so if we were to evaluate the entire position, it would look like the following. This would just be K, and this would be ET. So this is positive, then we know for sure this is going to be negative, right? Let's graph the positions. So unhedged, asset position, upward sloping curve. E underscore small t, and then E underscore capital T. Let's plus our hedged position. So let's try to understand what our hedging looks like. Our hedging looks like a negative ET and then a positive K. So that means it should look like this should be K and then it should be downward sloping, right? So this intersect point should be K equals E underscore T. And we can see what's going on here. So we get this one canceling out with this one, but we still get an upward sloping curve on the left side. So still downside risk, right? But in exchange, we get positive payoff above here, right? This is K equals ET. And sorry, I did the same mistake again. Sorry. Hitting a small drop in value. Yes. This should be man, I'm like I'm so tired today, sorry. All right, forgive me. So just small changes here. This should not be a long put. This should be a short call. Sorry. So that means executed if the strike price exceeds if the underlying asset price exceeds the strike and zero otherwise. So that should be correct now. This one should be C. I'll write positive C here. And this should be C minus E. And this should be ET, and this should be K. Yeah, I should have noticed this earlier. Okay, it should be correct now. Yes, so short call would mean that it's the mirror around the x-axis. So we can see that the intercept is K, and then it's downward sloping if ET is greater than K, which is that. And the final is an upward sloping curve, and which is less than K, right? So that's here. And then it's just a K payoff to the right? That's why it's here. So final payoffs to summarize again. E underscore capital T, the slope should be +1, so you see a positive slope. But then once it's to the right of K, it should just be a payoff equal to K. So it's capped, right? It's capped. If you were to factor in the cost, there is a shift in your payoff function that looks like this. And of course, this is assuming that K equals ET. This point here should be C. Again, I apologize. Yeah. So let me try to explain again the intuition. The intuition here is that you are not confident that there's going to be a super big drop, but there's most likely a small drop, which is fine. You can pay insurance for that, but you're going to trade that insurance for giving up your upside. So you can see that the upside is completely capped up here. But the good news is that even if you're wrong, you still get some protection here, right? So you sacrifice all your upside, you cap your upside at, in this case, C, which is great, actually, right? And then you get some downside risk in the case in which the underlying asset decreases, it's still positive, but once again exceeds some sort of amount, in other words, a large amount, then you're no longer protected, right? So no longer protected for large drop, right? You can see that. All right, so let me summarize again. Hedging against small drops in value presumes that you have an asset position. You're betting that the underlying asset will increase in value. Hence, in this row, right? Hence, in this row, you see that we pay for something today, but we have to buy. I mean, we buy something today and we sell it sometime in the future at E capital T. And our realization for that is always E capital T, regardless of the state of the world. In the case in which we expect a minor drop in value, we can hedge against that as opposed to a large drop in value, and we can take advantage of that by in this case, shorting a call, which means that we get some money today and hope that our counterparty doesn't actually execute. And our counterparty, we're hoping that the asset doesn't increase in value as much as large enough to eliminate our gains. Okay, our gains look a little bit different. It's sacrificing our upside, so you can see that our payoffs are capped at K. But we have some protection in which we are wrong, right? In which case, we have some protection here, a little bit, but if there's a large drop in value, we are no longer protected. So we still have that problem, right? But we're hoping that that's not the case, right? We're hoping that this hedge is, we're hoping that our hedge will capture reality, the future to some extent. Okay. Again, I apologize. I need to flip my pages, otherwise I get lost myself. Okay. All right, comments, questions on hedging against small drop in value. So naturally, the next thing is to look at hedging against small increases in value. Hedging against small increases in value. So let me just make sure this time we have a liability. And rather than selling a call, we're going to sell a put. Right? So let's go ahead, walk through what it looks like. All right, so if we have a liability, that means we sold something today and we had to buy it back cheap in the future, right? So hopefully I don't have to explain I didn't talk about shorting assets in the beginning. I just presumed that you guys know what shorting is. Okay, so shorting means you borrow some shares and you sell it today and you buy it back cheap sometime in the future. That's it. Okay, so shorting here, so liability means that you sold something today, so you get a plus E underscore T. But you have to buy it back sometime in the future, and you're praying that the underlying asset doesn't increase in value. Otherwise, you have to buy expensive. So just the liability position by itself, you have to incur this purchase no matter what. So E underscore capital T and E negative E minus underscore T, right? No matter what. We can hedge against the scenario in which we can hedge against this scenario by engaging in a sell put. That means we will gain some money today by selling it, and then praying that our underlying asset doesn't fall below K, right? If it does, then our payoff is negative K minus ET, right? Because we have to satisfy our we have to fulfill our counterparty agreement in which they exercise, and therefore we have to pay out K minus ET, right? Otherwise, our counterparty wouldn't exercise, and therefore our payoff is 0. So our final payoff at time on small t is ET plus P, which is obviously positive. Our payoff in the case in which the underlying asset falls below capital K is just minus K. And hopefully you can see that, because negative ET cancels out with positive ET, right? So it's just minus K. And we have negative E underscore T. Right? So you can kind of already visualize without drawing the final payoff that to the left of K, we have a just a fixed line, right? Negative K. But once we go beyond, once the underlying asset goes beyond K, above K, larger value than K, then our payoff becomes downward sloping, -1. Right? Okay, so I should here assume K equals plots. unhedged position, downward sloping curve. This is and adding our hedge position, we get a flat line to the right, 0, right? So then the origin is K. K equals T. We get a flat line 0 because we don't pay out anything if it exceeds K, but we get a minus K minus ET, which is a negative slope here. Sorry, positive slope, right? Minus positive slope. Okay. And our final graph should look like following. It should be here without considering the initial costs or benefit. That's minus K, right? And then if you want to factor in this, it should be a shift in the curve upward to here. And that intercept point should be P. Okay, so what's going on here? Here our initial payoff is unbounded if the underlying asset decreases in value, right? The lower it goes to 0, great, right? We make ET, right? We can give up some of this to hedge this, right? This possibility, and we can do that by selling a put. Sorry, by selling a put. What does this give us? This gives us a fixed payoff in the when the underlying asset falls below K, but we still get downside risk in the case in which there's a large increase in value of the underlying asset. So after adjusting for the initial payoff in the beginning, you can see it again, some insurance in which the underlying asset increases beyond K, but beyond a certain cutoff, your losses become very, very negative, right? So again, intuition, you're giving up some of your upside, or giving all of your upside for a potentially positive payoff. So as you can see, this is a positive value for sure. It's P in this case. That gives you some protection, some downside protection in the case in which there's a small increase in value. So again, small increase, that's fine. But when there's a large increase, you're not fine anymore. Okay, so the takeaway here is that you get some flexibility when it comes to options, right? So you can go extreme in which you completely hedge your downside, but you have to overcome a certain threshold to start making money. Or you can go subtle and try to sacrifice some of your upside to give yourself some downside insurance, right? So that's the idea. Let me summarize again. So here, for these cases, large drop in value or large increase in value, the intuition is that fully protect downside risk, and you have to overcome a larger threshold than K to make positive return, right? That's precisely what you saw. So if we go here, right, we see that this is the part of the curve, right? This is the part of the curve in which you must overcome before you start making positive returns. Oops. Whereas these small drops in value or small increases in value, you are exchanging unlimited upside for downside insurance, some downside for some downside insurance. All right, so the point of going through these examples is just to highlight that your payoff structure can actually look very funky and interesting if you decide to combine a lot of different types of call options. And hopefully, maybe in your derivatives class that you will take in the future or in the past already, you will learn about like butterfly spreads and bull spreads and whatever. So these are just different bets, different types of bets to make money, right? So you have to understand where prices are going to go, and if you can pinpoint where the prices will stay within certain bounds or above a certain bound or below a certain bound, you can make those spreads. I mean, make those precise bets using options. So this is just a very basic demonstration of refining your hedge, right? So in the case, so again, we only cover basically two cases. If you want to protect yourself completely from downside, you can go with these options. If you just want to exchange your unlimited upside for some downside protection or insurance, you can go this way, this route. Again, it's up to the risk manager's discretion how to pinpoint the risk, right? You have to understand what you're doing. All right, so comments, questions on these examples. So a question I may ask you is, suppose I go long and short certain call or put options at different strike prices. Show me what the payoff function looks like in a graph, right? That's a very typical MBA style question I could ask you. What you would do is you would draw a table or write a table, right? Calculate the equations for what the payoffs would look like given the different scenarios of ET realization, and then figure out how the lines should go up, slope up or slope down and so forth, and then you can draw it in a graph, right? That's a very typical MBA style question that's asked, that can be asked. All right. So yeah, I already summarized this. So the last two slides is a summaries of different approaches to go about making bets about the underlying asset. So if you believe the asset will increase in value, obviously you can buy the underlying asset. This is obvious, right? Just buy the stock if you believe it. But if you like to speculate, there's other ways to do it. One way is to go call option. Sure, they cost less. You don't have to spend so much money to buy a share. Call options typically are cheaper than the underlying share. But you have to pay the premium up front. Okay, so that's the downside. But you may not make money at all, right? You could be wrong on your call option bet, right? Because of the threshold. But at least if you have the asset and it increases in value, you can still make some money. But call option, there has to be a strike price. And if it doesn't exceed the strike price, you get nothing, right? That's the bet. If you don't go call, you can also sell put, and you know what selling put looks like, right? Selling put is it's like this, right? Something like that. So yeah, you receive the premium up front for sure. That's this thing, but then you get downside risk over here, right? So trade-offs. Okay, so it's up to you. Again, it's up to you as the risk manager to evaluate what sorts of risks you can take on and what is appropriate for your portfolio or your client or whatever. Okay. All right. So the opposite for decrease in value. So, right, sell the asset if you think it's gonna drop in value, but if you don't have the ability to borrow the asset to sell, then you can buy a put. Yeah, buy a put, but again, you're subject to that strike price. If it doesn't fall below the value, then you don't get anything. And of course, you can sell call again. You get the premium up front, but you still have unlimited downside, right? You still have downside risk. Okay. Okay. So that's supposed to give you an overview of what the contract ultimately pays off at maturity. Okay. So again, if you have background in derivatives, you know that I'm only talking about one specific type of options here. We're really talking about what's called European options here. Okay, so European just means that the exercise can only take place at the time of maturity. Exercise at time of maturity. But the vast majority of call options and put options today are what's called American options. And that means you can exercise anytime. Exercise anytime and anytime until up to maturity. All right. We will only be talking about this type of options in this class because that's because we have what's called a closed form solution for the option price, meaning we can solve for P and C. For American options, there is no closed form solutions. If I was teaching a derivatives class, I would give you a tool to price American options, but that's beyond this course. Okay, so just note that there is no, as far as I know, there's no closed form solution for American options, and the only way to price these options is through simulation, Monte Carlo simulation. So if you don't know what that is, don't worry, you'll never have to hear that again. Okay, so that's pricing, which we'll get to later. Okay, so before we get to pricing, I want to talk about how option prices change with respect to certain parameters, relevant parameters. So my objective here is just to give you the intuition, right? Just to give you the intuition as opposed to giving you the formula first, right? The pricing formula first, and then talking about the sensitivities. I think that's putting the cart in front of the horse. So let's just talk about why option prices should be sensitive to these certain parameters, irrelevant variables. Okay, so the first column, I'm looking at relevant parameters, which I think you should all be thinking about already. So we already know that the underlying asset price, we're talking about E, right? How does change in E impact the change in P or the change in C? Exercise price, we know that, that's K, right? How does the change in strike price impact call option value, put option value? Volatility is a bit tricky, okay? And we can think about it in a very intuitive way, but you won't see it, it won't make sense to you until you see it in the formula, which you'll see soon. Okay? So volatility just means the likelihood that the underlying asset fluctuates over time. And the greater the fluctuation, the higher the volatility. And we typically measure volatility with what's called standard deviation, right? You should know what that is. Okay, interest rates. So interest rates are relevant here because if you think about call options like contingent forward contracts, right, then it's the same idea. There's a cost to carrying the asset all the way to maturity. If the borrowing cost is high to carry the asset, to buy and carry the asset, the short side is going to transfer the cost to the buyer, right? That's the idea. Oh, okay. So I'm getting ahead of myself. So interest rates obviously should be related, right? Because call options looks somewhat similar with forward contracts because it looks like someone has to carry an asset and deliver conditional that the underlying asset exceeds or falls below some cutoff price, right? Okay. All right. Interest rates, we usually use what do we use this class? R, right? Let's just do R. Domestic interest rates, yeah, domestic. Okay, time until expiration. So that's maturity date. So this is like, so for forward contracts, that's 6 months, 9 months, 1 year, but you can also think about like maturity date, like a bond, right? That's just capital T, right? The larger the T, the more far away the contract it is, you have to think about. And lastly, forward interest rates as R star. All right, so all these variables you should be familiar to, right? The only new things really is just K and capital T, but everything else is you've seen before. All right, so let's talk about intuition here. Okay, so when I say call option value, I'm thinking about C and the price of C, which is a price. Okay, it's a price, and the variable P, again, which is also a price. It's the price of two different types of contracts, right? One is it bets that the underlying asset exceeds some threshold, and the other is that the underlying asset value falls below some threshold. If the underlying asset increases, all else equal means holding all other variables constant, it should be clear to you that the call option value should increase, right? Because for any strike price, as long as the underlying asset goes towards the strike price, the call option should be more valuable. So maybe I should write the payoff structure first above here. So rather than write C and P, I'm going to write the payoff. Should be max 0 and ET minus K. Right, that's the payoff at maturity. Okay, and the other one is max 0 K minus E underscore T. Okay. Yeah, so this is the payoff at maturity. All right, so intuition for this is an increase, the scenario of increasing the underlying asset price. How should it impact the call option value? Call option value is the expected value of max 0 ET minus K, discounted back to time 0. We haven't talked about it yet, but that's the idea. We have to calculate the expected value after discounting back to time 0 of this increase in ET. And if we increase ET, that means that ET value is increasing relative to ET minus K, right? Relative to K. And therefore, we're more likely to have a positive payoff. You concur? So that's why this is a positive relationship between the call option value and an increase in ET. In finance, this is called delta. Okay, so when someone says the delta of an option, they're talking about the sensitivity of the call option or put option when there is an increase in the underlying asset value by a unit. Okay, and it should be clear for call option, if you have a higher value for ET, the option value should also increase because it's a higher likelihood that the final underlying price exceeds the cutoff of K. The opposite should be true for put option. And that should be clear too based on this equation, because the higher the value of E underscore T, the more negative it is, right? The more negative it is, and therefore the more likely my payoff is going to be 0, right? We want ET to be very small for the put option, but if it's getting bigger, my put option value is going to be lower. Okay, exercise price. This should be also obvious, right? Based on the max function. If I increase K, it makes it harder for ET to be above K, right? And so this should be a negative and this should be a positive, right? The higher the K, the better for put option, right? Because I get to sell at a higher price and therefore buy it at ET, which is there's more chance of it being smaller than K than before. For call options, the opposite. If I have a higher strike price, then there's a lesser likelihood that the underlying asset can exceed it, right? And therefore, my call option value will drop when there's an increase in the strike price K. All right, volatility is usually represented by sigma. Let me just write it here. Sigma is equal to the square root of the variance of ET. Okay. Intuition. The intuition is the following. If the underlying asset is very, very volatile, just assume that we're looking at a stock price that's on average is flat, moving this way, but it's moving this way not very steadily. It's moving this way in this fashion, like super volatile. Okay. Yes, on average, it's going this way, but its realization is spiking up and spiking down, so highly volatile. So just based on that characterization, it should be clear that if I have either a call option or put option, there's going to be a higher chance that that spike is going to make my call option in the money, right? Because if it's super volatile, ET could suddenly spike from 1 to 100, in which case my call option becomes in the money and my option value becomes positive, right? So volatility is therefore increasing with both call option and put option value. Same logic for put option, right? If the price, although it's moving this way, if it suddenly hits, goes really, really negative, then that's going to make my put option very valuable, right? So perhaps the intuition is more opportunity to get in the money, right, for the future. Like even if it's just going this way, it's possible at maturity it can go really high or really down, really low, right? It can either go really high or really low, and we're just betting on that. If there's a high volatility, there's more chance that it goes one way or the other, right? This has a name. This sensitivity has a name. This sensitivity is called Vega. And that's just it's a Greek, it's not a Greek letter. I think it's just a V that looks curly. Okay. So far so good, right? So hopefully it's all still very intuitive, and we haven't even talked about option pricing yet to see the formula. Okay. All right, interest rates. The best way to think about this is to think about it from a forward contract, from the side of the short position. So if the short position has to borrow more expensive because of higher interest rates, they're going to pass the cost to the long position, right? They're going to pass along those costs. And from the perspective of both the forward contract and option, in this case, that cost should be reflected in the price. Do you agree? So let me say that again. Imagine the intuition is the following. Call options and forward contracts are similar. The discrepancy is the fact that the call option is contingent on the underlying asset exceeding the threshold. But the idea of the short side having to hold on to the asset and deliver sometime in the future still applies, right? And if it costs more to carry the asset or the currency or the commodity, they're going to transfer that cost to the long side. And so that's going to be reflected in the price of the long position, which is the price of the call option. So with higher interest rates, you're going to get higher call option value. And it should be clear that's the opposite for put option value, right? Because if it costs more, then I get less money, right, at the end. So let me write a note here. This is intuition. The intuition is C cash and carry logic from Ford. Future spot parity, right? This has a name in finance. This is called rho, and it looks like a curly P, but it's rho. Again, rho vega delta is the sensitivity of the option price with respect to these parameters or these variables. Time until expiration. So this is the maturity date. And I think this is also quite intuitive. So for both call option and put option, if you have a longer horizon until maturity, there's more that gives the underlying asset more opportunity to become in the money. So increasing maturity or increasing the time to maturity will increase both the value of the call option as well as the put option. This is called theta in for option pricers. So this, I will draw it. This is it's like a 0 with a line through it. Theta. All right, finally, foreign interest rate. I think the best way to understand this is just to go ahead and look at the UIP equation. So R minus R star equals to E hat E minus E over 2. So what is this saying? This equation is saying that the returns to the underlying asset is precisely priced by interest rate differentials. And if interest rate differentials were to get smaller because of an increase in foreign interest rates, that means that the asset return must be smaller as well, right? That's what the equation is saying, right? Again, UIP is saying interest rate differentials explain asset return, in this case, foreign currency return. Higher foreign interest rates means that the asset return, the underlying asset return, foreign currency return must decrease over time. So if asset returns will decrease, that means less likely that the call option will be in the money. So it's going to be a negative. And it's going to be the opposite for put option, right? Because you want the asset to go down. You want the asset value to go down. So it's great if R star is increasing. That makes my put option value much higher. All right. Clear? So hopefully the only new thing, right? The only new thing is if you've learned option pricing, the only new thing is here, right? And I gave you a way to understand it. But the typical way people explain this is with the fact that foreign interest rates behave like dividend payments. So let me just refresh your memory. Dividend payments, if you imagine a stock that emits dividends, if it emits dividends anytime from now until maturity, it will actually make the asset price worth less in the future. Why? Because the person holding onto the asset doesn't have to actually pay the dividends, right? It's not that dividends that's being transferred or sold or to the counterparty. It's the underlying asset. So if you have an asset that emits dividends, a stock that emits dividends, the price will actually stay lower than before, than if it didn't pay off dividends. So let me say that again. Compared to not paying off dividends, right? If the stock pays out dividends, the price will be lower than if it did not pay dividends, right? And so if you have dividend payments, the stock price in the future will be lower than if it did not, right? Because you don't have to, again, the idea is you don't have to deliver the dividends, you just deliver the stock, right? And the reverse for put options, right? Okay. If that doesn't make sense, then never mind. Just for currency valuations, just use UIP, and it's very straightforward how to understand R star. All right, comments, questions on options, option sensitivity to input variables. Okay, this is probably all you really need to understand as practitioners if you don't do option trading. Option trading requires fancy valuation models. If you're just thinking about hedging against certain risk, in this case, these are all the possible sources of risk you can think of, right? Volatility, namely underlying asset price fluctuations, interest rates, and foreign interest rates. If you have an understanding of the sensitivity, you know which way to hedge, right? Which way to hedge. Okay, so for those of you who don't have background in options, I'm going to give you a very high level explanation of how to price currency options. I'm going to go through slowly an example, a very trivial 2-period example of pricing options. 2-period in the sense that I'm only evaluating the price of the underlying asset from time 0 to time 1, and that's it. Okay, and hopefully that will give you an intuition what exactly options are. Okay, the punchline is options can be thought of as a leveraged position, meaning that you short something and you buy something. Okay, that's the idea to price options. We want to represent the option contract like a portfolio of 2 different types of assets. And once we can do that, we can therefore price the option easily, right? Because it's been decomposed into 2 types of assets. By itself, without this decomposition or transformation, it's not straightforward to price this. Okay, and I'll give you an intuition. I'll talk about the intuition after I show you this example. Okay. All right, so I talked about this already. So let's go ahead on the valuation. So this is called the binomial model because we're assuming that there's only 2 states of the world. The stock goes up by some percentage point or some percentage, and the stock goes down by some percentage. This is a very simplified world because we usually say like assume the stock has a normal distribution, right? And there's infinite possible realization of the stock, and very, very complex. And of course, in your derivatives class, you will derive the Black-Scholes equation, which is the pricing equation, in this case, in which the stock has infinite realization. But in the binomial tree model, we're only assuming there's 2 states of the world, okay, not infinite states. The stock goes up by some percentage, the stock goes down by some percentage. So let me start by giving you 2 assets in this world. Okay, so imagine the world's super simplified, only 2 assets, 1 bond that pays a interest rate no matter the state of the world. So when I say state of the world, I mean up and down. So 2 states, up and down. And a stock, risky stock. So it pays some percentage when it goes up and then some percentage when it goes down. So let's visualize this. So I'm going to draw one branch. Okay, just one branch because there's one stage. Okay. We have a bond. Let's say it's worth $100, or it has a par value of $100. It can pay interest of 10%, so 110, when this in the high state, or it can pay 110 in the low state. That's what a bond is, right? It pays a fixed income regardless of the state of the world. And for the sake of our example, let's assume that the state of the world can occur 50-50, like a coin flip. So far, so good, right? We have a bond, pays fixed income, 10%, regardless of the world. The world can diverge in two different states, 50-50, coin flip. For the stock, also has an asset price today at 100, for the sake of simplicity. The state of the world can diverge, two states, can go up, can go down, 50%, just like the bond. But its payoff is different. It's 120 in the upstate, so that's plus 20%, and minus 10% in the downstate. Okay, so let me emphasize that this 100 is a plus 10%, and this is a plus 10%, right? 10% from 100. This is a bond. This is a bond, and this is a risky stock. It doesn't have to be risky stock and risky foreign currency. It doesn't matter. Okay, just risky asset. Let's just write asset here. So far, so good. So the setup. Imagine a simplified world with only two assets. One asset pays a fixed income regardless of the state of the world, and the other pays a payoff, a risky payoff depending on the state of the world. If the state of the world is heads, it pays 20%. If the state of the world is tails, it pays negative 10%. With respect to the 100 price. Okay. All right, let's look at what a call option looks like in this world. So we focus on call option. We can do the same for put option, but let's just stick with call. So the call option price, we have no idea what that is, right? Let's just put a C. But we know what his payoff looks like in the future. It's max E underscore T minus K 0. You agree? We should all agree, right? That's a bet that the underlying price exceeds the strike price K. As long as it's positive, I get a payoff. And that should be equal to 20, right? Whereas the downstate, sorry, K is equal to 100. So in this case, K is equal to 100. And in the downstate, this should equal to 0. So remember, for the case for K equals 100. So maybe I write C. C if function K equals 100. Yeah, that's clear, right? So it's the call option contract. Call option contract with a strike price equal to 100. So if ET is 120, right? That's what ET is in this state. It's 120, 120. 120 minus 100 is 20. 20 is greater than 0. So my payoff for the contingent claim or call option is 20. For the downside, the bad states, we have 90, right? Is it 90? What do we call it? Yeah, 90, right? 90 minus 100, that's a negative number. I would not execute. So it's going to be 0. So my question for you is the price of this option simply the weighted average of the state by the payoff 20 and 0? And I think you should know the answer, right? It's obviously no. the first thing you should notice is that there's no discounting for time value of money. Where's the 1 divided by 1 plus r, right? Where's that? It's not even there, right? It's not there. So this is definitely wrong, right? This is wrong. It's not. The intuition here is based on this graph. We need 2 separate discount rates, right? Because we have 2 different states of the world, and therefore we actually need a different discount factor for each of the state of the world. That's why option pricing cannot be simply priced with capital asset pricing model. See CAPM. I don't know if you hopefully you've heard of CAPM. Okay, if not, it's just the most fundamental asset pricing model that people use to price all sorts of assets. Okay, you cannot price options with CAPM because CAPM, call options or options in general are contingent claims, in which case you need different discount rates for different states of the world. And that's kind of the intuition that you should get after we solve for this price in this special case. Okay, so let's go ahead and figure out how to solve for C in this scenario. So the way you should think about this is, how do I construct a portfolio of assets? Remember, there's only 2 types of assets in this world, bonds and stocks. Can I construct a portfolio of stocks or risky asset and bonds at time 0 that perfectly replicates this payoff of 20 and 0? Can I do it? We can find out, right? How do we do it? Using some very, very basic linear algebra, right? We use X and Y to denote holdings of stocks and bonds respectively, right? So 120 is the price of this risky stock or risky asset in the up state, right? In the good state. And 110 is the price of the bond in the good state. So 120 and 110. X amount of holdings in risky asset, Y amounts of holding in riskless asset. In the bad state, 0. The risky asset price is 90, right? Because it fell 10%. And the riskless asset still pays you the same fixed income of 110, right? Again, X and Y are 2 unknowns that is determined at the time of this tree, right? At time 0. So we want to have a holding of risky stock and bond that perfectly replicates the payoff of this call option, which is up 20, down 0, right? The question is, can we solve it? And of course, the answer is yes, right? This is just 2 equations, 2 unknowns, right? 2 equations, 2 unknowns. You can solve it by hand or solve by hand or use linear algebra to invert some matrices, but you don't have to know that. But anyways, you can definitely solve it by hand. And rather than give you the boring algebra, I'm just going to tell you the answer. The answer is you're going to have some positive holdings of the risky asset, and you're going to have negative holdings of the riskless bond. Right? So you should convince yourself by solving this equation yourself, okay? And after you solve for X, use the X, solve for Y, you get these 2 numbers, 2/3 and -6/10. The magnitudes of these numbers don't really matter because we're not talking about real money or real prices here, but the signs is what's the intuition here. Based on the signs, meaning plus or minus, we see that the call option, if we were to replicate it with a portfolio that we created at time 0, it is as if the option is a leveraged position, meaning that we borrowed some money and then went and bought some risky asset. So just based on that idea, you should be now convinced that options are quite risky, right? Riskier because you're leveraged. Okay. So this is the important takeaway. It's options are leveraged positions. So for put options, you'll get the same, but the mirror image, right? You're borrowing this risky asset, selling it, and then buying the riskless bond. So you'll see a negative sign on the X and a positive sign on the Y. Either way, you're borrowing some sort of asset and then buying the other asset. So based on this interpretation of options, in which we can replicate with a portfolio, so that's what the title here is, right? Replicating portfolio. Options can be seen as leveraged positions, meaning you borrowed something and then you went ahead and bought something. Cool, right? Pretty neat. But so based on that, we can actually stop here. So as long as you can replicate the payoff structure of the option using a binomial tree, okay, so we only did two stages, right? Two periods. Imagine doing the binomial tree over 10 periods. Right? You can do that, but the math, it just gets more complicated. But certainly if you do this, you can already tell that there is a way to price options now. As long as we can replicate the payoff structure of the option, we can price it by pricing the portfolio. Right? And it's easy to price the portfolio because we know the price of the stock, we know the price of the bond. We just need to determine the holdings, right, at time zero. All right, so what's the price of the call option? At time zero. We know this, right? Because we have the weights, the holding weights, 2/3 in risky, -6/11 for the bonds. Both assets are cost $100. That gives you the call option price of 12.12. Done, right? So that's pretty cool, right? But of course, as financial economists or accountants, I don't know, interested in finance, you want to know deeper the mechanism. What's really going on? Because you don't see the discount rate yet, right? Where's the 1/1 + R? Where's that? You want to see it, right? You want to see it somehow. So we can. I can show it to you, right? In this example. So let's generalize. So rather than 20% increase and 10% down, we'll just use a generic variable, 100 1 + U for up, right? And 100 1 + D for down. Okay, so D and U can be positive or negative. In this case, D is obviously negative, right? And U is positive. Still, we can assume 50-50, but as you will soon see, the 50-50 doesn't matter at all. So what that means is the actual likelihoods of up and down states is irrelevant, as you will soon see. Okay. And the bond is the same. We can also generalize this with just an R, right? So this is 100, and this is 100, 1 plus lowercase r, 100. So it's riskless means R is the same in both downstate, upstate, but U and D are different depending on upstate, downstate. So it's risky asset. This is risk bond. Okay. So yes. So this all I'm doing is replacing 20% negative 10% with UD, replacing 10% with R. Okay. That's all I'm doing. So the question I pose for you is the price of this call option worth 50-50, the call price of U and D, or CU and CD is just the max function? Of course not. We learned from the first the initial, right? We learned from the first tree that that's not true. So what we do, just like the exercise we did in the past example in which we had real numbers, we solve for a system of equations. We have the call option payoff for up, the call option payoff for D, and we have our two unknowns, which is the holdings for the riskless asset, which is Y, and the risky assets, which is X. And then we had two different types of realizations of up and down. Two equations, two unknowns, we can solve for a general solution. Of course, the algebra is messy, so I'm just going to give you the answer. But for those of you who want to convince yourself that what's going on, you should definitely try it out yourself. Okay. So the solution is the following. You have X equal to this, CU minus CD, and Y equals the following here. All right. These formulas don't really mean much yet. Okay. It's after we combine it to get the price of the option that becomes interesting. So assuming that the value of the stock and bond are equal to 1 instead of 100, then it's just Y, X plus Y, and you get the following equation here. So this is pretty cool now, right? You can see the inner workings now. There's a discount rate for one period, right? 1 over 1 plus R, pretty neat, right? That's cool. But we get two weights, right? We get R minus D over U minus D, and U minus R over U minus D. That weights the payoff of CU and CD. These two weights have a name. This is called the state contingent discount rate. Or in finance terminology, this is called the risk neutral probabilities. Okay? And I'll explain to you why it's called the risk neutral probabilities. But the intuition, of course, is state contingent discount rate. Right? That's what we've been looking for the whole time, right? We were looking for the fact that we need two different sets of discount rates for two different states, right? When the stock goes up beyond X, beyond K, or stock goes down below K or whatever, right? Whether the stock goes up, whether the stock goes down. And we got these discount rates, R minus D and U minus R. They're called risk neutral probabilities, and I'll show you why. But let me tell you why it's called that first. It's called that because with these probabilities, if you use these probabilities to price the stock and also the bond, you will get equivalent value, which means that it's as if the investor are risk neutral, because the price of the stock and the price of the bond gives you the same. The price of the stock and the price of the bond are equal using these probabilities instead of the real probabilities. So remember, the real probabilities is 50-50, right? 50-50. But that doesn't matter to us, right? If you look at the price equation, we don't care about real world probabilities anymore. The only thing we care about are these risk neutral probabilities. And these are the state contingent discount rates. Okay. With these risk neutral, if you decide to use the risk neutral probabilities to price the bond and the stock, you will get equal value using these weights, okay, as you will see, which suggests that the investor doesn't care about risk at all, right? Because they have the same return on average. Okay, so what you should note is the following numerators. R minus D and U minus R looks very familiar, right? It looks familiar, but a little bit foreign because we're talking about binomial trees, just two different states. But if you think hard enough, these R minus D and U minus R look something like volatility, right? So now you know why volatility matters in the price of the option. If R is greater than D, I'm sorry, if D gets really, really big, or U gets really, really big, right? Really, really negative or really, really positive, that's going to help us, right? That's going to help us increase the option value, right? The more negative the D is, that means the more positive it is, right? And the greater the U is, the more positive the price of the option too. So you have now volatility baked into the equation as well, right? These are volatility. All right, so let me demonstrate that these probabilities are in fact risk, makes the investor risk neutral. So if I were to price the bond using the discount rate of 1 over 1 plus 0.1, it's 0.1 because 10% is the return on the bond, right? And I use the weights 2/3 in our last example, right? We calculate the risk neutral probabilities as P equals 2/3, and therefore 1 minus P is 1/3. Yeah. Okay, so I forgot to do this part. So this is the risk neutral probability, and this is equal to, I wrote down here, so this is equal to 0.1 in the last example, 0.1 minus negative 0.1 minus negative 0.1 divided by 0.2 minus 0.1. And you should get 2/3. So using the previous examples values, R and D, right? We should get P, the risk neutral probability P equals 2/3. And therefore my minus P is this value. 1 minus P is this. You can prove it yourself later, okay? Just trust me. Okay, so with P equals to 2/3, we can go ahead and calculate the price of the bond using these risk neutral probabilities. So the discount rate is 1 over 1 plus 10%, right? Times the weights of 2/3, risk neutral probability 2/3 times 110, plus 1/3 times 110, which should give us 100, right? I think that's obvious, yeah? So 2/3, 110, 1/3 times 110 is just 110, divided by 1 over 1.1 is just 100, right? That's, so we, from that example, from those numbers, the price of the bond using these risk neutral probabilities tells us that even considering the time value of money, right, which we did, which is this thing, right? Time value of money, value of the bond is 100 today. Now using the same risk neutral probabilities to price the stock, you will also get the same value. So let me just write out what you should calculate. 2/3 of 120 plus 1/3 of 90, right? Should give you equal to 100. You should convince yourself. And takeaway is that these two values are the same, and they're the same because we use the risk neutral probabilities of 2/3, right? Instead of 50-50. Right. So although the payoff of the asset is random and thus risky, the risk neutral investor does not ask for a premium, right? Same price. It costs the same to the investor, even though this is risky. This is risky. Costs the same. So the investor is as if the investor is risk neutral. So takeaway. The takeaway is there's two ways to solve for the price of the option,
Number one is to create a replicating portfolio that mimics the payoff of the option, right? From time 0 to time t. If you can do that, then you just solve for that gigantic matrix, right, of systems of equations and solve for the price, the weights. Solve for the weights for the risky asset and the riskless asset, and then you can solve for the price of the option. Done. The other way to do it is to find the risk neutral probabilities. If you find the risk neutral probabilities, you can also price the option. Okay, that's so this is the Nobel Prize winning solution, okay, to the option pricing problem. Okay. So to summarize, right, risk neutral probability does not depend on what payoff you want to price, as right. The probabilities only depend on the volatility, as we saw, up and down, right? The more volatile it is, the more valuable the option contract becomes. Once you compute the risk neutral probabilities, you can apply it to any other payoffs. So it doesn't have to be a max function. It can be any sort of nonlinear function to be fine, okay? No problem. The replicating portfolio approach and the risk neutral probability approach gives you the same answer. Okay, this is the Nobel Prize right there. That's Nobel Prize. Okay, so I will finish up options after the 10-minute break. So I will just show you the continuous time version. So what I showed you here is discrete meaning that we break down time into steps, but in reality, time doesn't evolve stepwise. We usually imagine time evolves continuously, right? There's no steps, right? There's continuities in our time. And so I will give you the formula for it. You don't have to prove it in this class, but at least you know where it came from, and I'll tell you how to interpret the components after the break. All right, so I'll see you in 10 minutes. Yep.
I have a question. Can you explain one second for the UIP equation to
So if foreign interest rates become higher,
Yeah.
then the gap between R and R star is gonna be smaller, right?
Yeah.
That means based on, if UIP is correct, then that means asset returns must be lower in foreign currencies. So with lower returns, it means that the underlying value will expect to decrease, and that's gonna undermine your,
Oh,
because you're betting that the asset goes up, but it's going down if R star goes up.
okay.
So it's negative. And then obviously it's positive the other direction.
And so if the call option and the put option in this transaction only calculate buy and sell in the domestic, will the foreign interest import back then?
I mean, it's gonna be these are priced in domestic currencies, but the
Yeah.
underlying asset is a foreign currency. So your question is, you're gonna do a call option on. You're gonna do a call option on the domestic currency? Does that make sense?
Yeah.
No, I mean, it doesn't make sense. Yeah,
Oh,
so it's
okay.
only
Yeah,
for
yeah, yeah.
foreign currencies.
Okay, right, got it.
Yeah.
Yeah, thank you.
Yeah. All right, so let me finish up. So let me talk about the Black-Scholes formula. The difference between Black-Scholes and the binomial tree model that you saw just now is that time evolves continuously as opposed to in steps or discontinuous steps. The reason why you would use continuous time is because the math is actually more elegant that way. But in any case, let me give you some motivation why the Black-Scholes equation exists. So the question you should be asking yourself, okay, why do I have this extra new way of pricing things when I already have CAPM? So CAPM, basically, there's only one source of risk. It comes from the market risk, right? Beta. As long as you have beta, you can price anything plus the risk-free rate. But of course, that assumes that risk can be scaled linearly, right? Upside, downside, whatever. But as we saw from option contracts, their payoff are not, their exposure to risk is not linear, right? It's truncated for call options, for put options, and so forth, right? And it's these kinks appear because we have contingencies in which the payoff gives us zero or positive otherwise, right? And so this can't be accurately priced with CAPM. So if you do decide to price options with CAPM, what you're essentially doing is averaging the discount factor across different states, right? You can already tell that that's not exactly accurate, right? The most accurate description of what's going on is that we're having different states of the world that could realize itself, and different states must have different discount factors. And so a better and more accurate model will capture this up and down or no change state of the world. Okay, so if you do pursue quantitative finance, you'll be introduced to what's called a trinomial model, in which the stock doesn't change or the underlying asset doesn't change, and you still can go up and down. But anyways, that's the idea. Different states requires different discount factors, ideally. Otherwise, if you just do CAPM, you're just averaging the discount factor across different states, and that's not entirely accurate. So what we found from that example, right, in the previous slides, is that we use a trick. we use a trick to find essentially the risk neutral probabilities. But after identifying this risk neutral probabilities, we realize that what we've been doing is creating a replicating portfolio to mimic the payoff of the option. And if we're able to do that, then we're able to find the risk neutral probabilities, and then we can easily price these contingent claims, these options. And these risk neutral probabilities represent these state contingent discount factors, right? The different discount factors for different states. Of course, it gets very, very complicated for continuous time because you have infinite periods essentially, and you have to have portfolio weights that simulates the effective payoff of the contract over long periods of time. In the one stage, it's trivial, right? It's easy. But imagine you have 10 periods or 100 periods and so forth. The math becomes very complicated to some extent. Okay, so the trick that won the Nobel Prize is that once you identify the replicating portfolio or the risk neutral probabilities, all you have to do is, instead of relying on the real world probabilities like 50-50 coin flip, you rely on this fictitious risk neutral world probabilities to take the expected value of your payoff. So if you look at the call option contract, we can state the call option contract quite easily, right? It's just discounting the expected value of this max function back to time zero using the risk-free rate. But we have no idea what this expression looks like. What is EQ, right? We have no idea what it is until Black-Scholes showed up and showed us what it is, okay? So using the risk neutral probabilities, we plug in for Q. Q represents the probabilities of the world. We can therefore come up with an expression for expectations of this max function. So the math is tedious and complicated. You'll never need to know it unless you really want to go into quantitative finance. All right, so this is what it looks like afterwards. Okay, after you plug in the risk neutral probabilities and you come up with a close, and you rearrange the terms, you come up with this closed form solution. Looks like this. Don't be intimidated by these functions. Okay, it's not that sophisticated. These capital fees just means this normal cumulative distribution function, normal CDF, and it takes these parameters. Okay, you don't have to memorize it for this class. You don't have to take notes on it. Okay, you just have to realize the signs of these components of this call option price. Note, right? E is the price of the underlying asset, and we have this discount rate here, right? This is a positive value, right? E to the negative RFT. RF is the foreign currency, okay? Minus K. So positive and minus. Punchline, right? I mentioned to you earlier. The punchline is call option is a leveraged position. You see the minus K, you see the positive E. You can clearly see that it is a leveraged position. Pretty cool, right? Pretty neat. What's remarkable, if you haven't taken finance, maybe it's not remarkable, but for those of you who have taken finance and know about CAPM, you see that expected returns doesn't show up anywhere in the equation. There is no beta, right? There's no beta in this equation at all. So where is it? It's not used to price, right? So that's the remarkable thing about option pricing, is that we don't care about this market risk factor anymore. All that really matters really is this sigma here, right? Sigma shows up everywhere. Okay, so that's the neat thing about Black-Scholes. The math is super complicated. You don't need to know it unless you go into financial engineering. But hopefully you have a high level understanding of where this formula comes from. It comes from the fact that we can identify a replicating portfolio that mimics the call option or the option contract. The fact that we can find risk neutral probabilities, and once we have all those things, we can price the contract. Done. Okay. Okay. Comments, questions. I think there's okay. So yeah. So I should have probably went over these terms already, but if you haven't figured out already, so lowercase f is foreign currency. RF is foreign currency, interest rate for the foreign currency, and RD is the domestic interest rate for the domestic currency. So the only difference, the only thing you have to pay attention to for the Black-Scholes formula compared to the stock one is that we have this parameter here and this parameter here. So this is the same. This one is the same as before. Okay. The only new thing is this negative RF, but that term is already there if you consider dividends. Okay. So the way we interpret foreign interest rates is the same, again, the same logic for dividend paying stock. Instead of dividend payments, we have interest payments on deposits. It's the same idea. Okay. Okay. Put call parity is the same. So this is just something that must be true. Otherwise, you get arbitrage. I won't prove it, but if you've seen it, good. Otherwise, it's here if you need it. I won't test you on this. All right. So the question you'll be asking yourself is, what am I going to test you on for options, right? What I will test you on are this stuff, okay? Not this. Okay, I moved it here. Sorry. This stuff. So I most likely will give you some position. You have to figure it out if it's an asset position or a liability position. And I will ask you to construct a sophisticated portfolio of options. And you need to show me what it looks like graphically and also through a payoff table. So just be comfortable outlining a diagram for your final payoff and also drawing the payoff tables, right? And then doing some algebra to calculate what the final payoff conditional on what the final underlying price is going to be relative to the strike price, right? So this is just one contract here, one call option. Imagine I told you to buy 2 of these and then 3 of something else. You can calculate it, right? And then you have to be able to visualize it using a graph. Okay, that's the stuff I will test you on. I will not test you on deriving the binomial tree model for one period. I will not ask you to regurgitate Black-Scholes formula. I may ask you something related to the Greeks, right? I think you should all know the Greeks. So the Greeks is the sensitivity of the option price relative to certain parameters. You should definitely know this stuff. And hopefully I explained it with some intuition so that you don't have to memorize anything. You just have to think it through, right? Just think through the logic. And it should be obvious what the direction should be. All right, so that's options. That's the end of the risk management, currency risk management. So we covered swaps, we covered forward contract, we covered options, and now we understand the difference between regular assets, commodities to foreign currencies. It's just that extra interest rate term, right? How do you think of that? The way to think of that for forward contracts is we're swapping in the cost of the benefit with stock dividends. Now it's interpreted as forward interest rates. And for Black-Scholes, again, we're replacing the stock dividend parameter with forward interest rates. That's the only difference. Okay, everything else is the same. All right, comments, questions on risk management of foreign currencies. Okay, so the final half hour or so, I will talk as much as I can about Bitcoin. Okay. I don't know if there's a formal class you guys have to take for your master's, but I feel I'm obligated to talk about this because it's on the CFA exam. And this, after all, is an international finance class about currencies, and cryptocurrencies is a currency class, apparently. Okay, Bitcoin. As I said, why should you care? If you're planning on pursuing more finance and accounting, and you might pursue taking the CFA exam, it is on the level 1 and level 2 exam. Despite their claiming it, they're only interested in blockchains, they can't not talk about Bitcoin if they talk about blockchain. Okay, so you have to know something. Okay, why should other people care beyond students? Well, certain institutions, financial institutions or companies are looking better ways to utilize blockchain to accomplish certain things. So why do central banks, for example, care about cryptocurrencies? Well, they realized that cryptocurrencies is maybe an efficient way to track currencies. So the alternative to tracking currencies is using computers, but as you all know, computers can be hacked, and when you have everything centralized in one area, people can change numbers, and it's a giant mess, right? If you have things stored on the blockchain, the argument is when you have things that are decentralized in the way that they do it using cryptography, it's hard to change transactions. It's hard to create transactions, but it's also to change transactions that has occurred in the past. And so blockchain allows central banks to perhaps track their currencies and perhaps different assets easier. Okay, possible. But not only currencies. You can also use blockchain to track other things like digital art. But of course, you can track physical goods like diamonds, stocks, or I don't know, plutonium. So the idea here is that some people will want to try to counterfeit commodities, right? And they have to inscribe certain serial numbers on it. And if that commodity is not in a secure database, right, people can manipulate serial numbers. And if they store serial numbers on the blockchain, it's immutable, it's hard to change, and that's good for companies, right? To some extent. All right. So that's tracking things, right? Just as a way to track things. What has been attempted in 2017 is try to use the blockchain to try to raise money like initial public offerings. So you might have heard initial coin offerings. That's companies and startups trying to raise money by selling tokens or coins created out of thin air in exchange for money. And although they claim that they won't use the money, they won't use the tokens as if it's a claim on ownership of the firm. They say it's some kind of utility or benefit sometime in the future. I think that's all a scam. Okay. I don't know if there's any successful ICOs. I don't know if you know of any successful ICOs, but as far as I know, there's none. Most 99% of the ICOs were all scams. Some people do initial exchange offerings. So what that means is that they issue the currency tokens freely, and then they tell everyone, well, if you decide to buy tokens from us, then we may give value to your tokens to be able to liquidate if you put on an exchange, right? So it's kind of like issuing private shares and then doing like a backdoor merger, backdoor IPO, right? Backdoor listing, right? It's an indirect way to get listed and get liquidity for your shares. Again, but they claim that these ICOs or IEOs they're not issuing securities. They're claiming they're issuing some kind of utility token that you can redeem for goods and services or whatever. I don't believe that, and nor should you. But any case, this is what's being claimed. All right, and lastly, some people claim that cryptocurrency is just another way to hedge against, as a way to diversify. Some people claim that gold is not a good way to hedge against inflation. You should just buy Bitcoin because they have artificial scarcity built into it. I think there's 20 million Bitcoin max, right? By definition, it's scarce, but scarcity is not a sufficient condition for value, right? I hope you agree, right? Just because something is scarce doesn't mean it's valuable. But anyways, that's the argument. People can use this asset to hedge against certain things that's not that you can't hedge with other currencies or assets. And from a diversification standpoint, as long as you expand the possible space of assets, you can diversify your risk somehow, right? Okay, but I will show you some evidence if we have time today that there's no evidence that Bitcoin is any way correlated with the S&P 500 or gold. Okay, what it is correlated with is attention, as I proxy it with Google Trends Index. Okay, so I'll show you that if we have some time today. Otherwise, we'll continue tomorrow. Next week. All right. So rather than explain to you, how Bitcoin works myself, I'm just gonna let you watch a video, okay? This video is probably the best technical explanation I can find that's not too technical, but it is enough for you to kind of get a grasp of what exactly Bitcoin is. So let me find it. See, make sure I have enough time. Okay, so after this is over, we gotta stop. Now I'll finish up next week. So hopefully there's sound. The sound is really bad. Let me find it. If I can't find the sound, then I might just skip it and then I'll let you guys watch it later. Okay, I can push this in. Oh, good. All right.
Many people have heard of Bitcoin, that it's a fully digital currency with no government to issue it, and that no banks need to manage accounts and verify transactions. And also that no one really knows who invented it. And yet many people don't know the answer to this question, at least not in full. To get there, and to make sure that the technical details underlying the answer actually feel motivated, what we're going to do is walk through step by step how you might have invented your own version of Bitcoin. We'll start with you keeping track of payments with your friends using a digital ledger. And then as you start to trust your friends and the world around you less and less, and if you're clever enough to bring in a few ideas from cryptography to help circumvent the need for trust, what you end up with is what's called a cryptocurrency. You see, Bitcoin is just the first implemented example of a cryptocurrency. And now there are thousands more on exchanges with traditional currency. Walking the path of inventing your own can help to set the foundations for understanding some of the more recent players in the game and recognizing when and why there's room for different design choices. In fact, one of the reasons I chose this topic is that in the last year, there's been a huge amount of attention and investment and, well, honestly, hype directed at these currencies. And I'm not going to comment or speculate on the current or future exchange rates, but I think we'd all agree that anyone looking to buy a cryptocurrency should really know what it is. And I don't just mean in terms of analogies with vague connections to gold mining. I mean an actual direct description of what the computers are doing when we send, receive, and create cryptocurrency. One thing worth stressing, by the way, is that even though you and I are going to dig into the details here, and that takes meaningful time, you don't actually need to know those details if you just want to use the cryptocurrency. Just like you don't need to know the details of what happens under the hood when you swipe a credit card. Like any digital payment, there's lots of user-friendly applications that let you just send and receive the currencies without thinking about what's going on. The difference is that the backbone underlying this is not a bank that verifies transactions. Instead, it's a clever system of decentralized, trustless verification based on some of the math born in cryptography. But to start, I want you to actually set aside the thought of cryptocurrencies and all that just for a few minutes. We're going to begin the story with something more down to earth: ledgers and digital signatures. If you and your friends exchange money pretty frequently, paying your share of the dinner bill and such, it can be inconvenient to exchange cash all the time. So you might keep a communal ledger that records all of the payments that you intend to make some point in the future. Alice pays Bob $20, Bob pays Charlie $40, things like that. This ledger is going to be something public and accessible to everyone, like a website where anyone can go and just add new lines. And let's say that at the end of every month, you all get together, look at the list of transactions, and settle up. If you spent more than you received, you put that money in the pocket, and if you received more than you spent, you take that money out. So the protocol for being part of this very simple system might look like this. Anyone can add lines to the ledger, And at the end of every month, you all get together and settle up. Now, one problem with a public ledger like this is that anyone can add a line. So what's to prevent Bob from going and writing Alice paid Bob $100 without Alice approving? How are we supposed to trust that all of these transactions are what the sender meant them to be? Well, this is where the first bit of cryptography comes in, digital signatures. Like handwritten signatures, the idea here is that Alice should be able to add something next to that transaction that proves that she has seen it and that she's approved of it. And it should be infeasible for anyone else to forge that signature. At first, it might seem like a digital signature shouldn't even be possible. I mean, whatever data makes up that signature can just be read and copied by a computer. So how do you prevent forgeries? Well, the way this works is that everyone generates what's called a public key private key pair, each of which looks like some string of bits. The private key is sometimes also called a secret key, so that we can abbreviate it as SK, while abbreviating the public key as PK. Now, as the name suggests, this secret key, it's something you want to keep to yourself. In the real world, your handwritten signature looks the same no matter what document you sign. But a digital signature is actually much stronger because it changes to different messages. It looks like some string of ones and zeros, commonly something like 256 bits. And altering the message even slightly completely changes what the signature on that message should look like. Speaking a little more formally, producing a signature involves a function that depends both on the message itself and on your private key. The private key ensures that only you can produce that signature, and the fact that it depends on the message means that no one can just copy one of your signatures and then forge it on another message. Hand in hand with this is a second function used to verify that a signature is valid. And this is where the public key comes into play. All it does is output true or false to indicate if this was a signature produced by the private key associated with the public key that you're using for verification. I won't go into the details of how exactly both these functions work, but the idea is that it should be completely infeasible to find a valid signature if you don't know the secret key. Specifically, there's no strategy better than just guessing and checking random signatures, which you can check using the public key that everyone knows. Now think about how many signatures there are with a length of 256 bits. That's 2 to the power of 256. This is a stupidly large number. To call it astronomically large would be giving way too much credit to astronomy. In fact, I made a supplemental video devoted just to illustrating what a huge number this is. Right here, let's just say that when you verify that a signature against a given message is valid, you can feel extremely confident that the only way someone could have produced it is if they knew the secret key associated with the public key you used for verification. Now, making sure that people sign transactions on the ledger is pretty good, but there's one slight loophole. If Alice signs a transaction like Alice pays Bob $100, even though Bob can't forge Alice's signature on a new message, he could just copy that same line as many times as he wants. I mean, that message signature combination remains valid. To get around this, what we do is make it so that when you sign a transaction, the message has to also include some sort of unique ID associated with that transaction. That way, if Alice pays Bob $100 multiple times, each one of those lines on the ledger requires a completely new signature. All right, great. Digital signatures remove a huge aspect of trust in this initial protocol. But even still, if you were to really do this, you would be relying on an honor system instead. Namely, you're trusting that everyone will actually follow through and settle up as cash at the end of each month. What if, for example, Charlie racks up thousands of dollars in debt and just refuses to show up? The only real reason to revert back to cash to settle up is if some people, I'm looking at you, Charlie, owe a lot of money. So maybe you have a clever idea that you never actually have to settle up in cash as long as you have some way to prevent people from spending too much more than they can get. Maybe what you do is start by having everyone pay $100 into the pot, and then have the first few lines of the ledger read Alice gets $100, Bob gets $100, Charlie gets 100, etc. Now, just don't accept any transactions where someone is spending more than they already have on that ledger. For example, if the first two transactions are Charlie pays Alice $50 and Charlie pays Bob $50, if you were to try to add Charlie pays you $20, that would be invalid as if he had never signed it. Notice, this means that verifying a transaction requires knowing the full history of transactions up to that point. And this is more or less also going to be true in cryptocurrencies, so there's a little room for optimization. What's interesting here is that this step removes the connection between the ledger and actual physical US dollars. In theory, if everyone in the world was using this ledger, you could live your whole life just sending and receiving money on this ledger without ever having to convert to real US dollars. In fact, to emphasize this point, let's start referring to the quantities on the ledger as ledger dollars, or LD for short. You are, of course, free to exchange ledger dollars for real US dollars. For example, maybe Alice gives Bob a $10 bill in the real world. In exchange for him adding and signing the transaction, Bob pays Alice $10 ledger dollars through this communal ledger. But exchanges like that, they're not going to be guaranteed by the protocol. It's now more analogous to how you might exchange dollars for euros or any other currency on the open market. It's just its own independent thing. This is the first important thing to understand about Bitcoin or any other cryptocurrency. What it is a ledger. The history of transactions is the currency. Of course, with Bitcoin, money doesn't enter the ledger with people buying and using cash. I'll get to how new money enters the ledger in just a few minutes. But before that, there's actually an even more significant difference between our current system of ledger dollars and how cryptocurrencies work. So far, I've said that this ledger is in some public place, like a website where anyone can add new lines. But that would require trusting a central location, namely who hosts the website, who controls the rules of adding new lines. To remove that bit of trust, we'll have everybody keep their own copy of the ledger. Then when you want to make a transaction, like Alice pays Bob $100 ledger dollars, what you do is broadcast that out into the world for people to hear and to record on their own private ledgers. But unless you do something more, this system is absurdly bad. How could you get everyone to agree on what the right ledger is? When Bob receives a transaction, like Alice pays Bob $10 ledger dollars, how can he be sure that everyone else received and believes that same transaction? That he'll be able to later on go to Charlie and use those same $10 ledger dollars to make a transaction. Really, imagine yourself just listening to transactions being broadcast. How can you be sure that everyone else is recording the same transactions and in the same order? This is really the heart of the issue. This is an interesting puzzle. Can you come up with a protocol for how to accept or reject transactions and in what order, so that you can feel confident that anyone else in the world who's following that same protocol has a personal ledger that looks the same as yours? This is the problem addressed in the original Bitcoin. At a high level, the solution that Bitcoin offers is to trust whichever ledger has the most computational work put into it. I'll take a moment to explain exactly what that means. It involves this thing called a cryptographic hash function. The general idea that we're built to is that if you use computational work as a basis for what it does, you can make it so that fraudulent transactions and conflicting ledgers would require an infeasible amount of computation to bring about. Again, I'll remind you that this is getting well into the weeds beyond what anyone would need to know just to use a currency like this. But it's a really cool idea, and if you understand it, you understand the heart of Bitcoin and of other cryptocurrencies. So first things first, what's a hash function? The inputs for one of these functions can be any kind of message or file. It really doesn't matter. And the output is a string of bits with some kind of fixed length, like 256 bits. This output is called the hash or the digest of the message. And the intent is that it looks random. It's not random. It always gives the same output for a given input. But the idea is that if you slightly change the input, maybe editing just one of the characters, the resulting hash changes completely. In fact, for the hash function that I'm showing here, called SHA-256, the way the output changes as you slightly change that input is entirely unpredictable. You see, this is not just any hash function. It's a cryptographic hash function. That means it's infeasible to compute in the reverse direction. If I showed you some string of ones and zeros and asked you to find an input so that the SHA-256 hash of that input gives this exact string of bits, you will have no better method than to just guess and check. And again, if you want to feel for how much computation would be needed to go through 2 to the 256 guesses, just take a look at the supplement video. I actually had way too much fun learning that thing. You might think that if you just really dig into the details of how exactly this function works, you could reverse engineer the appropriate input without having to guess and check. But no one has ever figured out a way to do that. Interestingly, there's no cold, hard, rigorous proof that it's hard to compute in the reverse direction. And yet, a huge amount of modern security depends on cryptographic hash functions and the idea that they have this property. If you were to look at what algorithms underlie the secure connection that your browser is making with YouTube right now, or that it makes with your bank, you will likely see the name SHA-256 show up in there. For right now, our focus will just be on how such a function can prove that a particular list of transactions is associated with a large amount of computational effort. Imagine someone shows you a list of transactions, and they say, hey, I found a special number, so that when you put that number at the end of this list of transactions and apply SHA-256 to the entire thing, the first 30 bits of that output are all zeros. How hard do you think it was for them to find that number? Well, for a random message, the probability that a hash happens to start with 30 successive zeros is 1 in 2 to the 30, which is about 1 in a billion. And because SHA-256 is a cryptographic hash function, the only way to find a special number like that is just guessing and checking. So this person almost certainly had to go through about 1 billion different numbers before finding this special one. And once you know that number, it's really quick to verify. You just run the hash and see that there are 30 zeros. So in other words, you can verify that they went through a large amount of work, but without having to go through that same effort yourself. This is called a proof of work. And importantly, all of this work is intrinsically tied to the list of transactions. If you change one of those transactions, even slightly, it would completely change the hash. So you'd have to go through another billion guesses to find a new proof of work, a new number that makes it so that the hash of the altered list, together with this new number, starts with 30 zeros. So now think back to our distributed ledger situation. Everyone is there broadcasting transactions, and we want a way for them to agree on what the correct ledger is. As I said, the core idea behind the original Bitcoin statement is to have everyone trust whichever ledger has the most work put into it. The way this works is to first organize a given ledger into blocks, where each block consists of a list of transactions together with a proof of work. That is a special number so that the hash of the whole block starts with a bunch of zeros. For the moment, let's say that it has to start with 60 zeros. But later we'll return back to a more systematic way you might want to choose that. In the same way that a transaction is only considered valid when it's signed by the sender, a block is only considered valid if it has a proof of work. And also, to make sure that there's a standard order to these blocks, we'll make it so that a block has to contain the hash of the previous block at its header. That way, if you were to go back and change any one of the blocks, or to swap the order of 2 blocks, you would change the block that comes after it, which changes that block's hash, which changes the one that comes after it, and so on. That would require redoing all of the work, finding a new special number for each of these blocks that makes their hashes start with 60 zeros. Because blocks are chained together like this, instead of calling it a ledger, it's common to call it a blockchain. As part of our updated protocol, we'll now allow anyone in the world to be a block creator. What that means is that they're going to listen to the transaction being broadcast, collect it into some block, and then do a whole bunch of work to find the special number that makes the hash of that block start with 60 zeros. And once they find it, they broadcast out the block that they found. To reward a block creator for all this work, when she puts together a block, we'll allow her to include a very special transaction at the top of it, in which she gets, say, 10 ledger dollars out of thin air. This is called the block reward. And it's an exception to our usual rules about whether or not to accept transactions. It doesn't come from anyone, so it doesn't have to be signed. And it also means that the total number of ledger dollars in our economy increases with each new block. Creating blocks is often called mining, since it requires doing a lot of work and it introduces new bits of currency into the economy. But when you hear or read about miners, keep in mind that what they're really doing is listening for transactions, creating blocks, broadcasting those blocks, and getting rewarded with new money for doing so. From the miner's perspective, each block is kind of like a miniature lottery, where everyone is guessing numbers as fast as they can until one lucky individual finds a special number that makes the hash of the block start with many zeros, and they get the reward. For anyone else who just wants to use this system to make payments, instead of listening for transactions, they all start listening just for blocks being broadcast by miners and updating their own personal copies of the blockchain. Now, the key addition to our protocol is that if you hear two distinct blockchains with conflicting transaction histories, you defer to the longest one, the one with the most work put into it. If there's a tie, just wait until you hear an additional block that makes one of them longer. So even though there's no central authority and everyone is maintaining their own copy of the blockchain, if everyone agrees to give preference to whichever blockchain has the most work put into it, we have a way to arrive at decentralized consensus. To see why this makes for a trustworthy system and to understand at what point you should trust that a payment is legit, it's actually really helpful to walk through exactly what it would take to fool someone using this system. Maybe Alice is trying to fool Bob with a fraudulent block. Namely, she tries to send him one that includes her paying him $100 ledger dollars, but without broadcasting that block to the rest of the network. That way, everyone else still thinks that she has those $100 ledger dollars. To do this, she would have to find the valid proof of work before all of the other miners, each working on their own block. And that could definitely happen. Maybe Alice just happens to win this miniature lottery before everyone else. But Bob is still going to be hearing the broadcasts made by other miners. So to keep him believing this fraudulent block, Alice would have to do all of the work herself to keep adding blocks on this special fork in Bob's blockchain. It's different from what he's hearing from the rest of the miners. Remember, as per the protocol, Bob always trusts the longest chain that he knows about. Alice might be able to keep this up for a few blocks if just by chance she happens to find blocks more quickly than the rest of the miners on the network all combined. But unless she has close to 50% of the computing resources among all of the miners, the probability becomes overwhelming that the blockchain that all of the other miners are working on grows faster than the single fraudulent blockchain that Alice is needing to follow. So, after enough time, Bob's just going to reject what he's hearing from Alice in favor of the longer chain that everyone else is working on. Notice, that means that you shouldn't necessarily trust the new block that you hear immediately. Instead, you should wait for several new blocks to be added on top of it. If you still haven't heard of any longer blockchains, you can trust that this block is part of the same chain that everyone else is using. And with that, we've hit all the main ideas. This distributed ledger system, based on a proof of work, is more or less how the Bitcoin protocol works, and how many other cryptocurrencies work. There's just a few details to clear up. Earlier, I said that the proof of work might be to find a special number so that the hash of the block starts with 60 zeros. Well, the way the actual Bitcoin protocol works is to periodically change that number of zeros so that it should take, on average, 10 minutes to find a new block. So as there are more and more miners added to the network, the challenge actually gets harder and harder in such a way that this miniature lottery only has about one winner every 10 minutes. Many newer cryptocurrencies actually have much shorter block times than that. And all of the money in Bitcoin ultimately comes from some block reward. In the beginning, these rewards were 50 Bitcoin per block. There's actually a great website you can go to called Block Explorer that makes it easy to look through the Bitcoin blockchain. And if you look at the very first few blocks on the chain, they contain no transactions other than that 50 Bitcoin reward for the miner. But every 210,000 blocks, which is about every 4 years, that reward gets cut in half. So right now, the reward is 12.5 Bitcoin per block. And because this reward decreases geometrically over time, it means there will never be more than 21 million Bitcoin in existence. However, this doesn't mean that miners will stop earning money. In addition to the block reward, miners can also pick up transaction fees. the way this works is that whenever you make a payment, you can purely optionally include a little transaction fee with it that's going to go to the miner of whichever block includes that payment. The reason you might do that is to incentivize miners to actually include the transaction that you broadcast into the next block. You see, in Bitcoin, each block is limited to about 2,400 transactions, which many critics argue is unnecessarily restricted. For comparison, Visa processes an average of about 1,700 transactions per second, and are capable of handling more than 24,000 per second. This comparatively slow processing on Bitcoin makes for higher transaction fees, since that's what determines which transactions miners choose to include in a new block. All of this is far from a comprehensive coverage of cryptocurrencies. There are still many nuances and alternate design choices that I haven't even touched. But my hope is that this can provide a stable Wake-Up-Y style tree trunk of understanding for anyone looking to add a few more branches for further reading. Like I said at the start, one of the motives behind this is that a lot of money has started flowing towards cryptocurrencies. And even though I don't want to make any claims about whether that's a good or bad investment, I really do think that it's healthy for people getting into the game to at least know the fundamentals of the technology. As always, my sincerest thanks.
All right. So next week I will demonstrate the transaction of testnet Bitcoin and show you how long it really takes, as you expected. As you saw in the video, it takes about 10 minutes. It really does take 10 minutes for a transaction to be validated. And I will finish up that discussion next week on how to value Bitcoin using the models we learned in this class. So using purchasing power parity, using the quantitative theory of money, we can actually comment on the value of Bitcoin to some extent. And then I'll comment on what I really think Bitcoin is pricing using some econometrics. And after that, the rest of the time will be dedicated to going over sample test final exam questions. Okay, I'll see you guys next week.